This next panelist is going to teach us how to keep our money. Who here wants to do that? He personally helps Aaron keep his money. He has his own boutique wealth business. He has helped over 500 families, and he has flown in from Myrtle Beach just to give us that plan. Let's give a big round of applause for Justin Kramer!
I have never sold real estate. I don't have a real estate license, so I might be a little fish out of water here. But here's what I will do, because there's been a lot of really good content. John, Lars, I've really appreciated what you guys had to say. Kathleen, Jose. But here's what I want to do. I want to tell you about a huge problem that you have, but before I do that, I'm going to tell you how I'm going to solve it for you in 25 minutes. If you'll pay attention for 25 minutes, I'll show you how to make $50,000 to $250,000 more dollars this year without selling one more piece of real estate or doing one more hour of work. $50,000 to $250,000 in the next 25 minutes, okay? So you got to pay attention. I'd recommend you probably get out a note-taking device or something, because we're going to have to blow through some of this, right? Now, before I share what this problem is that you have, it was a problem that I had as well, I want to look at an illustration with you. How many of you know if you took a penny and you doubled it every day for 30 days? Okay, so 1 penny becomes 2, 2 becomes 4, 4 becomes 8. Double that penny every day for 30 days. What's that 1 penny now worth on the 30th day? Just blurt out some answers. What do you think?
6 million.
6 million. John says 6 million. Anybody else? It's like The Price is Right. You can just 10 million. $5,368,000. 1 penny. If you don't believe me, just Google it. It's right. I promise. $5,368,000. Now let's wait a second. We know in a society, in a country that we live in, anytime you make money, what do you have to pay? Of course. So let's assume that you're not in California or New York and you're paying 28% in federal taxes. So now my question to you is this. You double that penny every day for 30 days, and every time you double it, you owe 28% in taxes. What does that 28% tax do to that number on the 30th day? What's it worth now? Half? It's worth $67,000. Let's be clear on what we're looking at. There's a $5.3 million difference with a 28% tax. $5.3 million. So if it's not clear already, what do you think your biggest problem is? It's taxes. And here's the thing about taxes. It's the problem you don't know you have, but that other people around you are solving and you're not. Tom Wheelwright, who's the CPA, the personal CPA for Robert Kiyosaki, you guys know who that is? Rich Dad, Poor Dad? Is his personal CPA. Years ago, I was talking with an accountant, and I was tired of paying taxes. And she said to me, that's the price you pay to make money. I said, that's a stupid answer. I reject that answer. I don't know what the answer is, but it can't be that. And so I went out when I didn't have the money and paid his firm 5 figures to be my personal CPA. I've spent thousands of personal hours. I've gone through Yale's School of Business Theory and Wealth Management to get to this point, to figure out we got one big problem, taxes. And there's a better way to solve it. Because if you can read this, it says taxes don't just take your money, they steal your time. Because your time is your money. And we all know that intellectually, but I want you to think about this. You're making a trade every single day. I'm going to give my time to this in order to receive this back. And we do that for comfort, for identity, for lifestyle. There's lots of reasons we're willing to make that trade. And that trade is leading us to not really own our time. We're like well-paid slaves to a system that we're operating in. And here's what I have found with highly disciplined. I was a former college athlete. I know a lot of athletes and high personality A drivers, really disciplined. a lot of you. What's your solution to this problem? That's right. But first, before we make more money, let's talk about how many problems we have. It's not just your income tax, it's your retirement account tax. Do you know there's $32 trillion sitting in retirement accounts right now? $32 trillion that's never been taxed. That is instantly $14 trillion of revenue to the federal government if they simply require you to distribute that out. And by the way, that's not congressional approval. That takes the IRS commissioner stroking his pen on a piece of paper, and you're done. But you also have another problem with taxes. Anytime you buy an asset and it goes up in value, good for you. That was a good decision. But then you owe taxes on it. So it's not just your money you're making in a year. It's the money you're stuffing into retirement accounts, and it's the assets you're buying while you try to create financial freedom. You've got tax problems all the way down the line. And as John said, your solution is this: just make more money. That's not the right solution. Making money, and this is neuroscience, making money has the same addictive qualities as opioids. What do opioids tell you when you're using them? This is good for me. This makes me feel okay. I need to do more of this. So what if the solution is not making more money? Our solution is let's keep more money. Pause on that for a second. What if you could make the same amount of money that you made in 2021, if that was everybody's best year, and work half the time? Work 75% less. John Maynard Keynes, who's a really, really well-known economist, said the avoidance of taxes is the only intellectual pursuit that gives any reward. So here's what I want to do. I think I got like 18 minutes left. I want to give you solutions that you can stick in your pocket and take home with you on how to solve each one of those problems. Okay? All right, number one, income tax, meaning the taxes you pay your federal, state, and local governments in a given year based off the money you make. And there's all kinds of taxes. There's a net investment income surtax, it's 3.9%. There's local taxes. There's FICA taxes, Social Security and Medicare. There's taxes everywhere. I was in Washington, D.C. one time, and this guy I noticed across from me had a different accent. I said, hey man, where are you from? He said, I'm from Iceland. I said, oh, Iceland. I've heard Iceland's awesome. He goes, it's great there because everything's free. I said, what do you mean everything's free? He said, our education's free, our healthcare's free, all public transit. I said, what are you paying taxes? He says, 77%. I said, brother, that's not free. That's expensive. Okay. Real estate, in my opinion, is the single best asset class that anyone can own for wealth building and multi-generational wealth creation, period. And I could give you 1,000 pages of information supporting that. And I'm actually going to deep dive into this in a minute. There's two things specifically about real estate with the moment that we're in. Number one, bonus depreciation. If you don't know what that is, you are robbing yourself and the families that you work with. I did a presentation to a group of tax attorneys and CPAs on the tax benefits of real estate. Tax attorneys and CPAs, and they didn't know what bonus depreciation was. So let me be clear. It's very likely that the team that you've paid to help you figure out how to do stuff doesn't even know what your best asset and weapon does, which is real estate. That's a problem. That's a big problem. And I'm gonna unpack this in a second. The second is what's called Section 1250 property. Here's what it means. There are certain real estate properties that you can buy that get a larger tax deduction than any other type of real estate, period. Primarily gas stations, car washes, etc. We don't have time to dive into that, but I'll unpack again this concept here in just a minute. Number two, solar. 2 years ago, Tesla lost $800 billion on their profit and loss statement. You imagine running a business losing $800 billion? But then the government pressed a button and created for them $1.5 billion in tax credits. Just so you know what a tax credit is, it just means they make up something and now you don't owe what you owed. So on paper, Tesla 2 years ago made $700 million, even though they lost $800 million. That's what a tax credit is, and it's available for you. You can use solar on residential properties. Think about your primary residence. You can use them on commercial properties. The government will do this. They will give you money, 32% federal tax credit right now, and then they'll let you take the value of that and depreciate it. Panels, charging stations, vehicles, there's stuff available for all this. Again, I'm rapid firing. I want to get to some other stuff too. Number 3, profit sharing and pension planning. So here's the concept is you take income from a given year. Let's say you made $1 million this year, okay? You wanted to take $250,000 and just tell the IRS you're going to pay them later on it. That's what this is. And they're known by lots of names: cash balance plan, pension planning, pension trust, 401k, SEP IRA, solo Ks. There's lots of different names for them. But all you're doing is deferring your taxes on a portion of your income. And I'm going to show you in just a minute how you get it out, and somebody else is going to pay the tax bill for you. But again, this is a way, because we're focused right now, how do I lower my taxes on my income for this year? Oil and gas partnerships. Years ago, and I mean like 50 years ago, in the early 1970s, we were involved in an oil embargo. Many of our parents, odd day, even day at the pump. You might have heard about that. We were running out of gas. And so IRS and Congress get in a room together and they say, how can we solve this problem? IRS raises their hand. They say, listen, if you want an American to do anything, you give them a tax incentive to do it. So that's what they did. They said, for every dollar that you invest in a US-based IRS approved oil and gas partnership, we'll give you a 92 cents on the dollar deduction against your income. Imagine investing in something that pays you a quarterly cash flow, 100 grand. Let's say that you invest $100,000 in it, and immediately the government says, hey, $92,000 deduction on your taxes. Thank you. Because here's what you need to understand. The government doesn't do anything unless it's good for them. Why would the government be incentivized to get you to invest in oil and gas? Is because they view energy independence as a national security issue. They want you to do that. Why does real estate have more tax benefits than any other asset class? Is because right now, according to the Federal Housing Bureau data, we've got 5.9 million too few homes. We don't have enough homes. And then there's an estimated 14 million homes that no longer meet safety standards. They want you to build, buy, sell, develop real estate. And so they're going to incentivize you from taxes. So if you can understand, how do I align my personal vision and values with the deductions, credits, and stack them together? That's how you pay the least amount of taxes possible. This is no separate tax code system. This is available to anybody willing to think differently and get the people on their team that can help them do that. All right, we got to keep moving. Proper entity setup. This is a lot of folks make money and just pay taxes on it. But there's better ways: S corporations, partnerships, parent companies, C corps. There's a lot of different ways to make sure you're properly structuring how your revenue comes in. Because just like not all income is created equal, let me say that differently. There are good forms of income and there's bad forms of income. And you, being a sole proprietor real estate agent, is the highest taxed form of income that there is. So that's what my CPA told me to do. It's because your CPA is not thinking about how to save you taxes. They're thinking about how to push out 1,400 tax returns in a 90-day period. But my tax attorney said this would optimize my income. Your tax attorney's worried about billing $400 an hour. He's just trying to get you out the door. It's your responsibility to find somebody you can put on your team that can help you think differently. All right, your second problem. Before we do that, I want to go back to real estate for a second. Real estate is the only investment I've ever found that pays you 4 ways. Appreciation. It goes up in value if you buy it right. Tax benefits through depreciation. Somebody else is paying down your debt for you. Imagine that if somebody just made your house payment for you every month. You're creating equity on your own balance sheet because it's going up in value and the debt's going down. You see that? You're spreading equity every year. And then the fourth is positive cash flow. So I want to look at, this is a real example. 2017, President Trump passed the Tax Cuts and Jobs Act. And here's what it said. We're going to take real estate. And it shouldn't surprise you whether you like Donald Trump or not. It doesn't matter. Shouldn't be surprised as to why he leaned into real estate and the tax incentives that exist. And by the way, the reason he paid $750 in federal taxes is because this is exactly what he did. He used depreciation and bonus depreciation to make millions of dollars and pay virtually nothing in taxes. And if you had somebody smart enough on your team, you'd do the same thing. Now, a cost segregation study, here's what it does. The IRS has this little black book called the MAKERS system. It's Modified Account Cost Recovery System. Don't worry about it. They classify every possible piece and component in any type of real estate into that book, meaning plumbing, light fixtures, tile flooring, granite countertops, refrigerators, and they assign to it a depreciable life, meaning if you buy a $1,000 refrigerator and stick it in a rental property, they say you can deduct $200 a year for 5 years. Okay, that means that a refrigerator has a 5-year depreciable life. Do you guys see that? $1,000. The Maker's book says it's a 5-year depreciation. You can take $200 a year. Okay? What President Trump did is said anything in that little black book that has a 15-year depreciation schedule or less, you can depreciate it all up front into year one. That's bonus depreciation. Here's an easy rule of thumb. We've seen that you take about 20 to 25% of the purchase price of a piece of real estate, and that's approximately what you would be eligible for upfront bonus depreciation. Let's do easy math. You buy $1 million property, you should be getting somewhere between a $200,000 and $250,000 upfront deduction for purchasing an asset. I want you to think about that for a second. What you should be talking to individuals about, what you should be thinking about in your own personal financial life is, wait a second, somebody's going to give me a tax benefit to buy an asset that I own forever, that somebody else is paying down the debt on, that's going to appreciate in value, and I get positive cash flow? This is what wealthy families do. They live by something called buy, borrow, die. Buy assets that you can hold long-term, borrow against them because you receive those funds tax-free, and then just die because then your beneficiaries step up their basis in it. Buy, borrow, die. Now, I want to show you this. There's a number of moving parts, but I promise you this will lead to more listings, more sales, and you keeping more of your money in your pocket. Land is never depreciable. So let's look at a short-term rental as an example. That gets a lot of hype right now. Let's imagine that you had a $1 million short-term rental. And in that short-term rental, $200,000 was assigned to the land value. Cannot depreciate that. But $800,000 was assigned to the structure and all of its components in it. Are you guys with me on that? Okay. You're in the 35% bracket. This is just math, okay? $800,000. You would perform a cost segregation study. We estimate you'd probably get about a 30% deduction against that. This gives you a tax deduction of $240,000. If you're in the 35% bracket, the government gives you a check back for $84,000. I'm under contract right now with 3 separate rental properties. I can put 10% down right now on a property of this value. It's $100,000. I'm going to perform a cost segregation study and the government's going to get me back $84,000 in this scenario. That means I just secured a $1 million property for $16,000 out of pocket. By the way, on this particular rental property that I'm under, the cash on cash return is 60.4% before tax benefits. Aaron and I were talking in the back, and I actually love this analogy. I don't know if you guys have ever heard of Plato's cave allegory. The basic premise of Plato and the cave allegory is this. There was an individual who was in a cave and he had chains around his arms. There's chains around his wrists. And there was a wall in front of him and there's a bunch of people in the cave. And they can see the reflection of a fire behind them. Finally, one individual, one man takes off these chains because he realized they weren't locked, climbs up the cave, works through the rock and the bristle, and comes out and realizes that there's this whole other world out there. And here's what he does. This is Plato, Greek philosopher. He says that man goes down to the rest of the people in shackles and chains that are not locked, and they refuse to leave. This is an alternative reality that you have a choice whether to operate in or stay in the bubble that you're in right now. In this example, there we go. There's if you care about it, which I'm sure you don't, there's the Treasury reg and IRS code, doesn't matter. Okay, now let's put some solar panels on this, okay? Same deductions, we saved $84,000. We can go to a solar company right now and put $100,000 worth of solar panels on this particular property. By the way, solar companies are backed and financed by the federal government, which means you can go get $100,000 worth of solar panels for like 10 grand and they'll finance it for you like 2.9%. Okay? They give you a $32,000 credit and you can depreciate 84%. My team put the wrong number. It's 84%. That is a real tax savings of $146,000. Let's go back to this example because we're throwing a lot of numbers. I love numbers, but not everybody does. You buy $1 million property, you put 100 grand down, the government gives you back $146,000. You have no money in the deal and the government just paid you 50 grand to own an asset that produces positive cash flow and will appreciate. Hello? There are 50 different ways to do things like this. This will certainly help you with clients, with selling your real estate, but it needs to help you personally. All right, we got to keep moving. Retirement accounts, you got a big problem there. Here's some solutions. Roth conversion, something called a qualified plan transfer, which I'm going to talk about in just a second. If any of you have been in any kind of development, we had a family that she had $1.3 million in her IRA account, and they had done some real estate development, and they had what's called a net operating loss carry forward. It means they had lost money on a development. Not good. We took that, and we got all of their money out of her IRA, and she paid no taxes on it. We saved her $350,000 in taxes because we asked their CPA one question. And she asked me, how come my CPA's never told me about this? I said, well, you should not be asking me that. You should be asking your CPA that. We asked one question, we saved her $350,000 in taxes. Tax exempt structures, let's get to this. This is really good. This is really good. How many of you in here have any form of a retirement account? IRA, SEP IRA, 401k, anything like that? Okay, good. Pay attention. The reason you do that, the reason you put money into a structure like that is because you get a tax deduction for it. It grows tax deferred, which means you're just kicking the can down the road. And then the third reason is, you know, at some point in the future, you're going to have to pay taxes on it. You're just hoping you're in a lower tax bracket or that taxes are lower. Neither of those things will be true, by the way. Over the last 115 years of taxes, we are in the bottom third historically, meaning taxes have been higher 75% of the time over the last 115 years than they are today. Taxes are only going one place. We're not going to Iceland levels, but we're not staying where we are. So, you know, there's this brick wall, right? You're like in a glorified prison here in your retirement account. It is the worst type of investment account you can have. The government controls it. They tell you when you can take it out, how much you can take it out. If you take it out early, we're going to penalize you. By the way, we're not going to tell you what it'll cost to take it out until the year in which you want to do it. They can change the rules at any time without congressional approval. You can't give this account away. It's in your name and your name only. Andrew Carnegie and John Rockefeller said there's got to be a better way. Here's what they did. This was pioneered 100 years ago. They said, what if we put a life insurance wrapper around our retirement accounts? You say, life insurance, why do we do that? Because the insurance industry is the only tax-exempt industry in the United States. Think about it. You pay a homeowner's insurance policy. Let's say you pay $5,000. You have a total catastrophic loss. The insurance company writes you $1 million check. Do you owe taxes on that? No. You get into a car wreck. They give you an insurance check. Do you owe taxes on that? No. You become disabled and you have disability insurance and you get a check. Do you owe taxes on? No. The second largest lobbyist group in Washington is the insurance agency. They have tax-exempt status that no other industry has. So imagine you're invested in the S&P 500 or whatever you are investing in your 401k. Fine, keep doing that. But imagine putting a jacket that says life insurance on it and you still invested in those things. Now what happens? We distribute out, let's just use $1 million. Let's say you have $1 million in this account. You put a life insurance wrapper around it and we distribute that out. So let's be clear. You now have a $1 million taxable event on your personal tax return. You simply go to the insurance agency and they pay the tax bill for you. You said, no way. Yes way. We got tax attorneys around the country that have written opinion letters, IRS reviewed transactions called a qualified plan transfer. You take the retirement account money that you got a tax deduction in on the way in for. It grows tax deferred and you find somebody else to pay the tax bill for it. And oh, by the way, as long as you keep that tax or that life insurance wrapper around it, all the income that you receive from it is exempt from federal and state taxes. Imagine that you have $1 million in your retirement account and you're 40 years old and you're trying to get to your freedom number. That $1 million can't help you for 19 and a half years. 59 and a half is when you can take it out, right? Imagine if you could turn that on in 12 months. Imagine if that starts paying you $5,000 a month in tax-free income. These are strategies that ultra high net worth and ultra wealthy families use. Called a qualified plan transfer. All right, appreciated asset tax. This is just when you buy an asset. I'm just blowing through this because I want to get to the next piece. There's lots of different ways you can do this, right? Let me just say it this way. If you're paying taxes, you don't have the right people on your team. It's bottom line, period. There's 6,000 pages in the tax code. 5,973 of them tell you how to avoid paying taxes. There's only 27 pages that talk about raising taxes. That's it. So how's it going? What I mean by that is, does this actually work? Here's 4 clients. One client got referred to us September 30th of last year. He had $3,768,000 of income. His tax bill was $1,219,000. He said, Justin, can you lower our tax bill? I said, well, you've only given us 90 days, but yes, we can. His tax bill at the end of 2023 was $676,000. Number 2, another client came to us, made $633,000 last year. His federal tax rate was 19.1%. We cut it in half to 9.7%. Third example. This is a real estate agent, by the way, in Myrtle Beach. Made $900,000 last year. Federal tax bill, $211,000. We met twice. His federal tax bill was $95,000 after those 2 meetings. Number 4. This person is in this room right now. 2022 paid $275,000 in federal taxes, which is just way too much in taxes, by the way. Last year, for 2023, they paid $0 in federal taxes and got a $30,000 refund. Inevitably, a lot of this is new information for most of you. Might have heard bits and pieces. Information is not powerful. It's the application of the information that changes things. I'm going to be able to stick around and answer questions, and I love to do that. I want to be able to do that. But I'm not going to be able to do it for everybody. Right? You want to get me in a little corner, but hey, here's my situation. Here's what we have going. I've done enough of these. That's what happens, right? New information that feels powerful, and it should. Imagine if you owned your time. And everybody's been talking about, Kathleen's been talking about, John's been talking about, Laura's been talking about, Jose's been. Imagine if you owned your time again. Because here's what happens is when you sell yourself to the concept of simply making more money by working harder, it does something to your soul. I've got 4 young kids at home, ages 1 to 7. It did something to my soul to simply work harder and work more. And I went on a personal journey to say, I'm not going to do that. There's a story in the Bible about the Apostle Paul. And he's going around, he's really fired up about the good news of Jesus. And so he goes to this little town called Corinth. And you imagine he's just like hellfire and brimstone. He's just laying it on folks. And it says that there's these 2 individuals, a husband and a wife, Priscilla and Aquila. And they pull Paul aside. This is in the book of Corinthians. They pull Paul aside, and it says that they show him a more excellent way. And you can imagine that conversation like, hey, Paul, love your fire, love your intensity, appreciate what you're saying. Why don't we try saying it like this? This is a more excellent way for you to think about wealth building, to think about where your time goes, and to think about how you can save money without having to go make more money.
He flew in from Montana. He has been in the real estate industry for 20 years. He has served over 2,500 families.